Today, we're diving into one of finance's toughest challenges, objectively pinpointing market regime shifts as they happen. It's controversial because so many rely on gut feel or outdated tools. By the end of this video, you'll see how DetectRegimeShifts uses science to bring clarity and consistency to this critical task. Let's start with why this problem is so persistent in finance. Markets aren't static. They cycle through regimes like bull runs, bear crashes, and sideways volatility. At quarantadue.ai, every MCP workflow starts from the real tool interface, not from a generic prompt. The goal is simple. Keep the expert in control while the system structures the evidence. Inputs, reasoning, and outputs stay connected in one reviewable flow. Now the results become easier to compare, easier to review, and easier to explain. But traditional methods like technical analysis or simple indicators often lag or give conflicting signals. This leads to missed opportunities and inconsistent decisions across trading teams. Generic tools fail because they don't adapt to changing market structures or handle the noise in real-time data. The real challenge is achieving objectivity and speed without requiring a PhD in statistics. Now let's explore the technical method behind DetectRegimeShifts. At its core, it uses statistical models and machine learning algorithms to analyze price action, volume, and other market metrics. These methods look for patterns and probabilities that signal a regime transition. Key concepts include Markov switching models, clustering techniques, and anomaly detection. It's not about predicting the future, it's about recognizing the present state with high confidence. A common misconception is that regime detection requires complex coding or massive computational power. DetectRegimeShifts simplifies this by automating the heavy lifting. Next, the software solution. DetectRegimeShifts ingests live market data from multiple sources, establishing baselines for different regimes. It runs continuous calculations to assess the likelihood of a shift, providing clear alerts when thresholds are crossed. Every analysis is logged in an audit trail for compliance, ensuring transparency. You can also model scenarios to see how potential regime changes might impact your positions. This isn't just a black box. It's a tool built for finance professionals who need reliability and explainability. Let me walk you through a hypothetical example. Imagine you're monitoring a portfolio during a period of low volatility. DetectRegimeShifts tracks variables like volatility spikes, correlation breaks, and momentum shifts. If it detects a statistical increase in volatility and a breakdown in typical correlations, it flags a potential shift to a volatile regime. You'd receive an alert allowing you to adjust hedges or reduce exposure measured by a change in your risk metrics. This proactive move could mitigate losses without making any performance claims. Now, on compliance and reporting. DetectRegimeShifts generates detailed reports that summarize detected shifts, the data used, and the confidence levels. These reports are designed for stakeholder readability with clear visuals and non-technical language. They align with regulatory requirements by documenting the decision-making process, helping you demonstrate due diligence. Finally, let's summarize. DetectRegimeShifts offers objective, real-time regime detection, reducing reliance on subjective judgment. It enhances consistency across teams, saves computational resources, and supports compliant reporting. To see how it can fit into your workflow,